Let's talk ETFs, but not the kind that put you to sleep faster than a PowerPoint presentation. This isn't gonna be one of those dry breakdowns that make you question every life choice you made. If you pick the wrong fund, you might find your money leaking away like socks in a dryer vortex. We're going deep into the heavyweight matchup, SCHG versus QQQM, classic growth versus tech dominance. By the time we're done, you'll understand why your choice shapes your financial future. Here's what usually happens when people start investing. They open their favorite trading app, type in best ETF, and start scrolling. They see charts, they see percentages, they see arrows, and without thinking twice, they just pick the one that went up the most last year. I used to think I was clever chasing one-year returns, but focusing on past performance alone is like using Google Maps with half the information missing. Returns are just one piece of the puzzle. You've got to pop the hood and see what's really driving these ETFs. First up is SCHG, the Schwab US Large Cap Growth ETF. Picture it as a seasoned fisherman casting a wide net across America's 750 largest companies. What makes it stand out is balance. SCHG isn't just tech-heavy. It spreads your money across various sectors, creating a sturdy, all-weather foundation. Now cue the spotlight for QQQM, the Invesco Nasdaq 100 ETF. If SCHG is a buffet, QQQM is an exclusive Silicon Valley dinner party. It focuses on just 101 non-financial giants: Apple, Microsoft, Nvidia, Amazon, Meta, Costco, Netflix, companies shaping our lives. Investing in QQQM is like buying a front-row ticket to the future with exposure to AI, cloud, and cutting-edge tech. But that concentrated power also makes it more volatile. Thrilling when markets soar, but bumpier in downturns. Now let's talk about something most investors overlook: fees. They're like termites that can eat away at your returns. SCHG charges an ultra-low 0.04%, while QQQM's 0.15% is nearly 4 times higher, compounding into thousands over decades. If two investors both put $10,000 into their ETF every year for 30 years, the one paying lower fees could end up with tens of thousands more. Cost efficiency in investing is like getting front-row concert tickets for half the price, simply because you paid attention. Owning an ETF doesn't automatically mean diversification. SCHG and QQQM appear diversified, but share many of the same top-heavy holdings. Over half of both ETFs are dominated by the same 10 mega-cap companies, which can expose your portfolio to the same risks. A bad quarter from a giant like Apple can ripple across all growth-focused ETFs, impacting your returns. The real differences between SCHG and QQQM show in the final 10 to 15% of their holdings, with SCHG including more diverse sectors. SCHG includes financials like Visa and MasterCard, and healthcare like Eli Lilly, diversifying your exposure to various growth engines. QQQM focuses on main tech sectors, offering greater volatility with substantial swings, perfect for those seeking substantial growth. SCHG delivers a balanced approach with steady returns, funding your entertainment and health advancements through diverse sectors. Both SCHG and QQQM have produced about 18% annual returns, effectively doubling investments over 5 years. However, QQQ tends to outperform over a 10 to 15-year span due to its tech-heavy focus on innovation and growth. With technology as the driving force, Consider your investment strategy and your tolerance for market turbulence. But higher returns come with higher risk. The market isn't a steady climb. It's a roller coaster with sharp drops and wild turns. In 2022, inflation fears and rising rates made growth stocks less attractive. Both SCHG and QQQM took a hit. SCHG fell about 36%, and QQQM sank roughly 32.5%. This shows that growth doesn't always mean smooth sailing. Moments like that are the real test of an investor's discipline. Surviving the downswings builds true wealth. Most beginners sell during crashes, locking in losses, but those who stay the course tend to come out stronger. History shows every single crash in the last 100 years has turned into a new high. Understanding volatility is crucial. SCHG's broader diversification means it weathers downturns better than QQQM, which can be more exposed to tech sell-offs. When the market rebounds, QQQM often bounces back faster because its core holdings, like Nvidia, Amazon, and Apple, lead the next rally. How do you use this information for a smarter portfolio? The key is understanding your time horizon, goals, and emotional tolerance. If you're young with decades before retirement, volatility isn't your enemy, it's your friend. Those dips are discounts on long-term growth. If you're mid-career and can't afford to lose 40%, consider a more stable core. A 60-40 or 70-30 split might make more sense. As you approach retirement, preservation becomes the name of the game. Protecting what you've built matters more than chasing extra percentage points. You might keep QQQM as a smaller slice, 10% or 20%, to retain growth potential, while most money could sit in SCHG or dividend-paying ETFs like SCHD or VIG. The right choice isn't the same for everyone. It's about building a mix that reflects your timeline and temperament. The hardest part of investing is mastering your own behavior. The biggest threat to your portfolio isn't inflation or interest rates, it's you. Panic selling during correction and waiting for things to calm down can hurt you. The market rewards the calmest, not the smartest. Consistency beats brilliance. Investing steadily and ignoring the noise often leads to better outcomes than chasing trends. If you invested $10,000 into the S&P 500 in 2003 and stayed invested through 2023, you'd have around $70,000. But if you missed just the 10 best days in those 20 years, your return drops by nearly half. That's the cost of impatience. The worst thing you can do is panic sell at the bottom. Those moments often set up the biggest gains. Time in the market matters far more than timing the market. Focus on how long you stay invested. When you combine SCHG and QQQM, you blend two philosophies: structure with innovation and balance with potential. Markets will crash. Headlines will scream. Talking heads will predict doom. Understand how to react when things go wrong. Volatility isn't a signal to run. It's a feature of the system. Learn to see those moments as opportunities. Whether you're leaning toward SCHG for stability or QQQM for innovation, the real key is patience. Investing is about stacking base hits. Show up month after month and let compounding do its work. There's no single winner because the right choice depends on your values, stability, or acceleration. If you're the type of investor who wants to set it and forget it, SCHG is hard to beat. Its ultra-low fees and diversified sector exposure make it reliable. SCHG offers consistent performance, making it the kind of ETF you can hold for decades without losing sleep. It's the steady engine of your portfolio. Because it spreads your money across many different industries, SCHG is less vulnerable to single-sector meltdowns or sudden market shifts. On the other hand, if you're hungry for maximum growth, QQQM is your ticket. It focuses on tech and disruptive innovation for bigger swings. When tech is booming, QQQM tends to outperform broader growth ETFs like SCHG, offering potentially higher rewards. If you're okay with a bumpier ride and can stomach the volatility, QQQM can supercharge your returns and give you exposure to leading businesses. You don't have to pick one. The smartest portfolios treat SCHG and QQQM as teammates. SCHG gives you structure, stability, and cost efficiency that every portfolio needs. QQM adds the spark and upside potential that can make a good portfolio great. Blending them gives you a resilient portfolio that takes advantage of bull markets. Think of it like building a car. SCHG is the reliable engine, QQQM is the turbocharger. Fees are the single most underestimated factor in long-term investing. A 0.10% difference could mean the difference between retiring with comfortable or life-changing money. If you invest $10,000 a year for 30 years with an 8% return, a 0.15% fee leaves you with about $1.09 million. With a lower 0.04% fee, that amount can increase to about $1.12 million, which is an extra $30,000. Investors can't control market fluctuations, but they can control investment costs, which compound over time. Many believe owning multiple ETFs means diversification. But if they hold the same top stocks, you're just paying more. SCHG offers broader sector exposure, unlike QQQM's tech focus. Together, they enhance your growth potential. Most people think they lose money because of bad investments. In reality, they lose money because of bad decisions. They panic sell during market drops. They buy into hype when things are overpriced. Your job isn't to predict those swings, it's to survive them. If you can resist the urge to sell during a 30% drop, and if you can stay invested through the noise, you'll outperform the vast majority of investors. SCHG and QQQM aren't just investment vehicles. They're behavioral tools that test your patience and reward your discipline. With the right mindset, one focused on decades, not days, they become powerful engines of wealth creation. If you want a buy-it-and-forget-it ETF with minimal fees, broad diversification, and reliable growth, SCHG is the clear winner. If you want to lean into innovation, embrace volatility, and maximize your exposure to tomorrow's companies, QQQM is the more aggressive choice. To take advantage of both philosophies, own both SCHG and QQQM. SCHG gives a calm, predictable foundation that grows steadily, while QQQM brings excitement and potential for outsized gains. Fees matter more than you think. Diversification is more complicated than it looks. Your emotions will decide your wealth. Your future wealth won't be determined by a single ETF choice. but by your ability to invest consistently and ignore the noise.